gold has been trapped now for 18 months. And it still remains trapped, but we're getting really close. And so what I said was what was going to release it, if you will, in this 3-year correction.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited to have a guest back on the show that we talked with a couple of times last year, a prolific historian and student of the gold and silver markets, and that is Don Durrett of goldstockdata.com. And we actually just had a really fun conversation about some of the things that going on in the gold and silver markets even before we hit the record button. So glad we're started, and great to have you on in here today, Don. It's nice to catch up with you again. How are you doing today?
I'm doing good, Chris. Thanks for having me back. Yeah, I brought 3 charts with me today that are really interesting. Gold traded almost below 1900 today. 1901 was the spot close. It hasn't traded below 1900 since March 13th. I think this is the last correction. I think it's begun. I think in the next 90 days, we're going to find a bottom here.
Yeah, especially with some of the data that's come out on the COT report as of last week. We've seen a lot of the spec funds getting rid of their long positions, and certainly a lot to suggest we may have seen the brunt of the sell-off. Although perhaps to start, you were giving me an overview of how you see things going in the next year. Obviously, sentiment in gold and silver not too strong right now, in the mining stocks almost as low as it's been in a couple of years. And perhaps we could start there on where things stand now and what you see in the broader view of you can start with gold and then touch on silver.
Yeah, sure. Just a quick overview where my head's at. So we've been in a 3-year correction. It's really interesting. It started in August of 2020. So here we are in August 2023. So we're at the 3-year correction, and it looks like gold is trying to finally, and I'll show you those charts, are trying to finally get a breakout. This is like we haven't had the capitulation in this. So the markets have been in correction now since 21. So we went all through 22, and then 22, maybe it was early 22 when we basically started breaking down. I get the exact time. Yeah. Bring up the S&P. Let's see when the S&P when it hit its high at 48. Well, maybe that was October. So in January of 2022, I basically, late January, early February, I came to the conclusion that gold was had a problem because the markets weren't rolling over. And so if the markets weren't going to roll over, gold was trapped. And so gold has been trapped now for 18 months. And it still remains trapped, but we're getting really close. And so what I said was what was going to release it, if you will, in this 3-year correction would be the stock market rolling over and capitulating. And so it hasn't capitulated. I'm going to go ahead and share my screen.
Sure.
And show you. We'll start with the S&P, and I'll show you what I mean. So, yeah. So here was the top. It looks like it was right at the end of 2022 when the S&P hit 4818. It was a little over 4,800.
You mean beginning of 22?
Right at the beginning, yes, the beginning of 22, right at the end of 21. And I thought it was all the way back to 21. And so then we started doing this bear market began in 22, so early 22. And it basically crashed all the way down and touched the 200-week moving average. 200-week moving average. And that was in October of last year. And that's when we started this run, this 8-month run that we've been on. 2023, that's 2022. Yeah, so of October of last year. So now we've been on this run, and a lot of people thought, this was going to these last months here have been a reignition of this bull market in the stock market. And I don't think it is. I think that I don't expect, maybe the high was 4,600. I think that's probably going to be the high. If it's not the high, we might go back and retest it one more time. We're going to know by the end of this month. If we don't get back, say above 4,500 or start, then I don't think we're going to see 4,600 this year. And September is going to be this big selling, if you will. So here we are. It looks like we're in this correction, and this could be the beginning of the recession, and this could be basically the capitulation selling that I'm expecting. So if we look at this green line, this 200-week moving average, you'll see that we touched it back in 2019, and then we bounced, and then in COVID, and then March, April, when COVID hit, we basically broke down, but it was a false breakout, and then it really went on that big run from 2020 all the way to the end of 21 to 4,800, and now we touched it again. And it was another false breakout, but we haven't had any capitulation selling. So the capitulation selling almost occurred when we went to 3,500, but it didn't break down, it bounced. So we've never had really capitulation selling in this big. As a matter of fact, we haven't had a big high volume day through this whole correction in the market. And so now, once we get below 4,200, I think that is when the fear trade in gold is going to kick in. It's going to start, but and gold has the potential to get a bid somewhere between 4,200 and 3,800. And so the key level here is going to be that green line. Well, they're all kind of key. I think 4,200 and 4,000 are going to be key. Each level we go below those, the fear trade is potentially going to kick in a gear, because people are going to start to get nervous. And as they get nervous, they're going to want to buy gold. So gold has the potential to get a bid. And so then you get a decoupling where gold's going up and the markets are going down. And gold is basically hanging in there. And I think the key level is that green line, which is right around 3,900. So once it gets to 3,800, this is the S&P, by the way, the 3,800 or 3,700, those two levels to me are the really, really important levels for gold, because that is when gold needs to get a bid. If gold doesn't get a bid, and when I say a bid, I mean it's basically trending up and it's no longer trending down. So it's currently at 1901, and I'm praying that 1,800 holds. And so when gold gets down here, 4,200, 4,000, 3,900, I need gold to basically be getting holding 1,800. And we're going to know at 38 or 37 if it holds. Either gold's going to break down really hard and it's going to be brutal for like PM miners, or it's going to bounce and decouple. So that's the S&P. Now, if we I want to look at the HUI, then we'll look at gold. So the
ask a question before you get to the HUI? If we go back to S&P for a second.
Sure.
One thing I'm wondering, obviously we talk a lot about in the metals, is that we're getting close to the end of the interest rate hikes. And I could certainly see when there's finally a pause there, let alone when we start getting rate cuts, which perhaps outside of more banking issues, which certainly is a possibility, but outside of that,
right,
not seeing rate cuts probably until 2024. But if we get a pause in the Fed policy, I guess the thing that concerns me from that stock market perspective is that you wonder if that will be a green light for the equities to take off again. How do you factor that in if we do get the Fed finally pausing, let's say they come in September and say they're done?
Yeah, pausing is not going to help the market. They'll have to cut to help the market. And like you said, no cuts this year. The only way you're going to get a cut this year is if the market goes below, say, 3,500, and the Fed gets really nervous about, recession, and they want to nip that in the bud and not allow the market to melt down. So the only way you're going to get a cut, and again, a pause isn't going to help. We're at 5.5 right now. We have high rates. Pause doesn't help. Even if they don't raise in September, they don't raise in October, and kind of we get an official pause. That's not going to help. People are going to be screaming for cuts, and you're not going to get a cut until 3,500, I don't think. They don't want to cut. They want their tools back. They only have two tools. Tool number one is to lower rates to zero, ability to lower rates to zero to basically, prevent a meltdown in the economy. And then tool number two is the ability to print as much money as they need to print to prevent a meltdown in the economy. Their number one agenda is not, so they're supposed to have a two-pronged, policy, the Fed. Number one is full employment. Number two is price stability or lack of inflation. But that's not their number one agenda. Their number one agenda is economic stability, preventing the economy from melting down. That's number one. And in order to prevent the economy from melting down, they need their two tools. And that's why they're fighting inflation today. They're fighting inflation because if they can get inflation back under control, they have their tools back. That's why they want those tools back. It's not about fighting inflation more than it is about the tools. So that's that. And so since they want those tools back, they're not going to cut interest rates early unless they have to. And so have to is basically, in my opinion, 3,500 or lower. That answers your question?
Yep.
Okay, great. So this chart is beautiful for if you're a mining investor, a gold mining investor, silver mining investor. So this is the HUI over a monthly period, and it basically starts with that black line is 225. I consider the HUI, this is what I use to determine when I basically buy stock, my entry price, when I buy. So I consider 250 on the HUI to be what I call the neutral level. So I'm okay buying, around 250. I don't like to buy above 250. But between 250 and 225, I don't really like to buy, but I'll buy stocks that are really cheap. But once you go below 225, I call that the buy zone. And we went into the buy zone today, and I actually bought 3 stocks. I bought stocks I already own, but I wanted to lower my cost basis because I think they're just oversold. And those were Aveeno, Silvercrest, and Hummingbird. I just think those stocks are all 10 bagger plus, and I wanted to add shares because they're just sold off, and they're all producers, and so I just like the risk reward. So once we get in this buy zone, it's like I gotta do something here. So now that we're in this buy zone, I'm actually going to buy to the bottom. Now, where is the bottom going to be? So now if we go back to 2013, this is when the market broke down. And you can see that when the market broke down, if you look at these big red candles, look where it stopped. The last red candle to the bottom was basically right at 225. And then it hugged 225 for a year. and then it made a little break. Then it broke down with these 2 big red candles here, saying, okay, 225 is not going to hold. Broke down, and then some people said, okay, I'm going to buy there at 160. And then it went down, went further. It went all the way down to 100. So it went from 225, which everybody thought was a bottom, all the way down to 100 in 2016, which was kind of in crazy land. But that was your low. That was when you wanted to buy. So you basically wanted to be buying. You could buy this entire channel, below 225. It depends on what stocks you're buying, of course, but looking for cheap stocks. Then after it hit this bottom in 2015, it was actually 2015. Then it broke. It broke out. It actually made a run. You see these 3 candles. It took 4 candles to go from 115, let's say, all the way to 225. It made quite a run. That's how explosive these miners can be. This thing can go up 100 points in 3 months with no problem. And I think it will this time. I think it'll go from 225 to 325 in 3 months when it does break out. It's going to do one of these numbers. Okay, so it tried to break out. Well, look where it went. It went up to the 200-week moving average, and it immediately hit a wall and bounced back down and went, look what it did. It went under the 225 level. So we broke it. We tried to break out. It couldn't. Came back down to this important, what I call the byline, and got below 225, and then it stayed there for look how many years. So this red candle right here, look where it was at, it actually opened on the 200 week, went back down under it, and then stayed in this channel for 2 years, which is kind of crazy. And then it finally broke out when COVID hit in the summer of 220. And we broke out, we got it this big, huge. And this is the one thing where you can really tell these important levels, is because when they do break above them, you get these big candles. So we get this massive green candle. And I think this is April of 20, right after COVID hit. It could be May. And April, May, June, July. It looks like it's April. So then it basically made this big run all the way up to 360. And it couldn't hold, and it broke down, and we basically kind of got stuck in this choppy land. And you didn't really want to be buying in here. You wanted to wait and see what happened, because gold was trapped. And then we went back into this channel, so you had a chance to buy some stocks here, and then we broke out. And I haven't been buying any stocks. So once we got above this 225 line, I haven't been buying. I've been waiting to get back in the channel, and we're in the channel here. So if you look at this, we've had higher lows. Look at this beautiful support line. Look at all these touches. So this support line should hold right around 195, 200. We might go a little bit below it. Maybe we go down to 190 and it's a false breakdown. But I don't think we go any lower than 190 here. So buy to the bottom. So we're at 218 right now. Basically, we're looking at about a 10% sell-off. And this is where the 1800 is so important. So 1800 and 200, so $1,800 gold and 200 on the HUI basically coincide together. That's why I think it's going to hold. They're both of the, so look at all this support on the HUI. And now, one thing I wanted to show you is that I think this is going to happen over the next 90 days. We're going to get a bottom. And then once we get above 225, I think we're going to go to 325 fairly quickly. I'm thinking 3 months is something, we're there. And then once we get above 300 on the HUI, it's basically off to the races time. Then it's going to go then over the next 2 years, it should go to 1,000. So this 10-year consolidation, I think, is going to end in the next 90 days. Okay, so now let me show you the gold chart. This is my last chart. And this is what I mean.
One quick question on the previous chart. Is it that 320 level? That's where you expect finally we see some more mainstream, wider fund participation joining in and really driving things higher?
Yeah, absolutely. Absolutely. And so we break above the 360 level. So yeah, 320, 330, that's when your institutional money jumps in. And then you get above this 360 level, and it's basically blue sky. And so that's when you're off to the races. And here's your 200-week moving average at 300. So you get to 320, and yeah, you're going to get a lot of people jumping on board. Absolutely.
Okay, that makes sense.
Okay, so here's this gold chart. Remember I said, they coincide. So you look at this support line, which is just beautiful. Now we look at this channel right here. So this one goes all the way back to 2011. And so gold basically stayed down here. This was actually, this is a channel as well. I could draw a line here, and we had this big channel. But this is where gold, the reason why I drew it here is because this green candle right here, and this was in December, I think, of 2020. This is when gold broke out. Right in here, this was December of 2019. So the end of 2019. So this is 2019, this is 2021. So right here in the middle, this green right here, these two green candles at $1,400 gold. This is when we broke out of this 6-7 year channel, this 7-year basing. And then this is the breakout. And so the big breakout was this green candle right here, which was right at $1,600. And then the other one is you have this 200-week moving average, which is above 1600. So and then you have this bottom. So we have the breakout, and then we have back the retest, 1615. So this 1600 level is, really is support. But I don't think we're going down there. But this is this is what scares me. What scares me is that 1800 doesn't hold, and then we go back down and retest 1600, or maybe we go back down to 17 or 1650. I do not want to go back in this channel. And so we see this 200-week moving average, which is currently right at 1800. So that's support. And then here, if you look left, this is where it really coincides with the 200 on the HUI, is these touches over here on the left. So here was this breakout in 2011 above 1800, and it couldn't hold. It got a little bit above 1800, and the following month it opened right above 1800, and then it crashed. And then it closed all the way at 1600. So in that month, it went down $200. And once it did that, once it went down $200, it was game over. There was nothing it could do to hold up. It went up and it retested 1800 4 times. You see this little, this wick? Right. So you have a wick here, you have a wick here, you have a wick here, and you wick here. It went back and retested 1800 4 times. Well, that is really good for us. So what it did was it put in support. And so now this should hold because of all that support. And look at all these monthly touches that we had over the last 3 years. A lot of touches. So 1800 should hold. And if 1800 holds, then the HUI should hold 195, 200. So I'm bullish because I think that if 1800 holds, I've been saying this, I've tweeted this at least 20 times. I said, if 1800 holds this year on gold, we go to a new high. And then next year is like, the best year that we've had in a long time for gold. Next year we go, 23, 2500 gold next year, if 1800 holds here. So this all goes back to, basically the economic fundamentals, if you will. So before we get off the charts, do you have any questions on this HUI?
No, that makes sense.
On the gold chart?
No, I mean, that makes sense. And certainly when you mix in the economic backdrop behind that, touching on what you said with a breakdown in the S&P, and obviously we've seen data slowing. I know I saw on your Twitter feed that you're not a big fan of Janet Yellen's economic assessment, that everything is rosy out there, but certainly makes sense what you're saying there. Add in the fact, and if you care to comment on, we talked a little bit about that Brics announcement that is coming up next week, and so certainly a lot of factors suggesting that even with the recent sell-off, that could be near the bottom. And did you have anything you'd like to add on the Brics there?
Let's start with Yellen, and then we'll go to the Brics. So the two main groups that are basically pounding the table that the economy is strong and ignoring kind of the underlying kind of data, and we'll get to some of that, is really only coming from two groups, right? It's coming from the administration, and it's in their interest, right? It's in their interest to remain bullish and kind of spin the economy, everything's good, And then the other group is Wall Street, and it's in their interest for things to remain good. But I follow the basically the brilliant macro minds who basically manage money and who make money if they're right or not, the hedge funds, the guys the 2 and 20 guys who need to be right. And those guys, most of them are bearish. Michael Burry had a tweet. There was a tweet out yesterday. Burry, the 13F came out, and he was, short the market. And that guy's pretty bright, right? So he's looking at all the data, and he's basically going, I don't trust this thing at all, right? Jeremy Grantham, another guy who I think is very bright, he said that the only thing that he really wants to own right now are commodities and gold. Doesn't want to own any other stocks except for commodities and gold. And he says that this is the biggest bubble that he's ever seen. I mean, going back to 1929, because it's, he calls it the everything bubble, and he's basically saying that there's a train wreck ahead of us. And I couldn't agree more with him. And if you listen to him analyze it, he does it very methodically, right? He looks at all the data points. And really the problem with the economy, the reason why it's not as robust as basically, these two groups that I said are basically kind of pounding the table on, is that the economy has been basically lacking strength, if you will, since the dot-com bubble popped in 2000. So, I mean, if you go back to 2000, we basically had a recession from 2000 until 9/11 hit the year later. And then that recession lingered for 2 more years until Bernanke basically injected enough money to get the economy, took rates really down, created that bubble in the stock market, created a bubble in housing. And so we basically started this whole idea of basically bubbles, inject money, lower rates. It was basically a false economy. We didn't let the economy die on its own, grow on its own. We basically destroyed the free market after 9/11. And then artificial low rates. And then he created that bubble in the housing. And he also created a bubble in financials. And so you had this, basically, we had the great financial recession in 2007, 8, 9. And that was from the bubble popping. And then Bernanke basically lowered rates again. And that's when we started MMT. So MMT is, nobody's really kind of defined it per se, but it's this idea with Japan back in 1990, what they did, we had to put a name to it. So Japan had this massive bubble, and instead of letting companies go bankrupt, they bailed them out, and then they lowered rates to 0, and they injected money, and they started accumulating debt. So that's what we're doing now. So they basically took rates to 0. They even took them negative. They took their 10-year and they pegged it at 0. I mean, a 10-year at 0, right? So it's 0 rates. And then they expanded their money supply like crazy, which China emulated them in the 2000s. So they expanded their money supply. Right now, their debt to GDP is like 200%. It's over 200%. Before that happened, I think it was 0. I don't think they had any debt in 1980. And so they'd use a combination. And then simultaneous to that, their central bank bailed out companies, bailed out banks, bailed out bonds. It was bailout after bailout, low interest rates. And simultaneous to that, throughout the 90s, they really didn't have a harsh recession. They basically had a little bit of growth here, they didn't have a harsh recession throughout the 90s. It basically stopped recessions, but it also stopped growth. But it was basically a manipulated economy. But where the MMT came in, it was this idea that if you have a money printer, that debt doesn't matter. So Japan said, hell, debt doesn't matter. We can have as much debt as we want. We just print it. So they went into this idea that debt doesn't matter. If we need money, we print it. We need money, we print it. Whenever they needed money, they printed it. So 2000, the first decade of this century, the US basically copied Japan. And China was doing it as well. They're printing money like crazy. And Europe as well. Europe kind of they followed us. But we started using this idea, which I think is MMT, is a combination. It's basically 3 planks. Plank number 1 is low interest rates. Plank number 2 is injecting money, basically, printing money whenever you need it. And plank number 3 is don't worry about debt. Debt is a secondary thing. And you notice since we started doing that, nobody even talked in Washington, the politicians, nobody even mentioned $1 trillion deficits, $2 trillion deficits. Going all the way back to 2001, you won't see anybody talking about cutting debt, cutting the deficit. until inflation popped up in 2022, excuse me. Once inflation came up, the Republicans said, oh no, we got a debt problem. But until inflation popped up, nobody said a word for 20 years. That's kind of MMT in action. And so MMT destroys the free market, which we've done. We've destroyed our free market. This is the reason why the economy is in such dire straits right now, because when you destroy the market, there's no price discovery. Because when you have artificial low rates, how do you know what a company's worth? We have corporations that are losing money. I was reading where I forget, it's like, I don't want to throw a number out there, I'm going to be wrong, but a large percentage of small businesses that are trading on the Russell are basically losing money right now. I thought it was in the about 30%, maybe it's less than that. But a big chunk of them right now are losing money. And the reason why it suddenly became an issue is because previously they were borrowing money at zero. So it didn't matter. They're basically zombie companies. And now they're going, uh-oh, we're losing money. We can't roll it. We can't borrow money here. It's at 5%. So 5% is a big problem. And so it's what's happened. The thing to really look at it, and this is what Grantham goes over, is what's happened over the last 20 years. What he says, two of the big factors that he says that are kind of damaged the economy, if you will. Number one is this idea that companies are not investing for CapEx. Instead, they're buying back their stock. And if you buy back your stock, it makes it look everything's rosy because your stock market keeps going higher and you're not spending money to do CapEx. So it looks like you're more profitable. It basically puts a false picture of the economy. And so he says all these buybacks that have been happening are not healthy. That's number one. Number two is the boomers have been retiring left and right. And as the boomers retire, that's less money, their income. So, the average boomer is probably making $100,000 a year. He retires and now he's just getting Social Security and he's not getting as much income. So his income just gets cut in half. So his spending gets cut in half. That's been happening left and right. And now all the boomers are retiring and nobody's replacing them. So you have less, these high paying jobs are just going away because the corporations, when somebody, a VP, let's say a VP is making $200,000 a year and he retires, they bring somebody to replace him. They only give him 125, right? They don't replace, because he's been there for 30 years. So he's basically making top dollar. But the new guy that comes in or the new gal that comes in, they don't get top dollar. So it hurts the economy. So the demographics are hurting the economy. And then, of course, inflation. Inflation is a killer because at least 30% right now of Americans, because of inflation, because of the purchasing power got kind of zapped, their lifestyle got damaged and they're living paycheck to paycheck and they can't buy everything they need. They're hurting. And so how is the economy solid when you got 30% of Americans who are hurting? Whereas, before inflation popped up, they were doing okay. Now they're not doing okay. Now they basically, they can't afford their phone. They can't afford their cable. They can't afford their rent. What do they pay for? There's a lot of people out there right now who can't pay their bills because of this inflationary surge. They just don't have the buying power, haven't got the income. And so this is the lag effect. So now you get the lag effect that's starting to happen. And the lag effect is these people that I'm talking about, how they have to stop, we're going to have, I'll give you an example is the banks. The banks, they're the ones that are really going to take it on the chops. So you have commercial real estate. So those are non-recourse loans. So people are just when they have to roll over the loan, they're basically going to say, here's the building, here's the keys. Right. So banks are going to lose a ton of money on commercial real estate. Then you got mortgage delinquencies. And so that's what I was saying. These consumers, they can't afford their mortgages anymore because of the inflationary pressure. When you take the whole household budget together and they add it all up, it's like it doesn't work. And so we have to rent something cheaper. So you're going to have mortgage delinquencies. Then you have credit card delinquencies. Those are going to pick up. Then you have auto delinquencies. Those are going to pick up. So all these are going to pick up that are going to create, this is the lag effect that's going to happen. And like I said, Janet's not talking about it and Wall Street's not talking about it. The lag effect hasn't happened yet. It's coming where all these people can't afford this, these payments. The payments aren't going down. And I keep hearing people saying that, we're going to have deflation. Well, deflation just means that prices are rising slower than they were before. It doesn't mean that prices have dropped. So all these increases in prices are going to stay high. They're not going down. Your grocery bill is not going down. Your utility bill is not going down. They're all, your insurance bill is not going down. Once they go up, they stay up, right? The only thing that tends to go up and down is oil, of course.
And then that's back rising again, which is going to hurt
right,
the inflation numbers going forward.
Yeah. Yeah. And the other one is like housing, because lumber prices will go down. And then housing can go up and down sometimes on commodity prices. But, I'm really only touching the surface here on the kind of damage that's been done to the economy. I mean, if we look at COVID, if we look at how small business was damaged by COVID, now they have to deal with inflation to get back on their feet. That's not easy to do. So a lot of these small businesses have been hanging on, and they're not going to be able to hang on much longer. And so that's a problem because of the COVID damage. Then you have Ukraine. Ukraine is probably the biggest event of everything I've said for the last 5 minutes. Ukraine is probably the number one issue that's going to harm the U.S. economy. And the reason why it's going to harm the U.S. economy is because the whole global dynamic, trade dynamic, has been upset. The apple cart has been upset. The relationships that the U.S. had with China has been damaged. China now is becoming, they were already our economic enemy. Now they're taking it to the next level with this Brics, and we're getting to the Brics. That's what we're getting to. That's where I'll go after talking about Ukraine. So Ukraine basically damaged the whole energy system. Before, Russia was sending their oil through pipelines to Europe. Now they can't. Europe won't buy their oil, so now they have to truck it. I mean, not truck it. They have to use ships, and which costs more money and takes more time other places in the world. And so the supply channels are all basically getting all messed up. Then when you have higher energy prices in Europe, that impacts U.S. corporations. U.S. corporations get 40% of the profits overseas. So now Europe in a recession, going to stay in a recession for the next 2 years because of high energy prices. Last winter, they basically had a lot of inventory. This winter, they won't. Natural gas prices are going to start trending up higher in Europe. Europe is basically going to be an economic mess. That's not going to get fixed because high energy prices are not going to go back down. So Germany, which is the engine of Europe, their economy has been damaged because of this Ukraine war, and it's not going to go back. And then the supply channels have all been damaged. And then China, I mean, they're not going to, the prices, like I said, prices don't go back down. So the stuff we buy from China is now going to cost more money. And now we get to the Brics. Okay, so I read today that the Brics said that they have, I think, 23 countries have applied.
Right.
And those 23 countries are all probably going to be accepted. So before you had 5, and now we're going to go to 28. Those 28 countries are all going to de-dollarize to a certain extent. We don't know how much they're going to de-dollarize, but to a certain extent, because they all, put it this way, Russia and China have taken the lead on this, and they want to de-dollarize. So they're going to put pressure on these other countries to de-dollarize. I saw today on Twitter, a little podcast, somebody said that UAE was going to sell oil to India in rupees, never been done before. Before it was always done in dollars. So all these countries are de-dollarizing. It's one of those ones, slow at first and then all at once kind of thing. So this is going to put downward pressure on the dollar. And I think what's going to happen, and let's go to the Brics. So I think the Brics are going to announce something at this conference. I don't know what, but they're going to either say, I think, one or two things. One, they're going to say, we're working on a new currency. And number two, and they're basically going to say, but we don't know what we have no idea what it's going to be. We're just talking. We're talking about it. And the other one, they'll be more optimistic, and they'll basically say it's going to happen. It's just a matter of when. So there's going to be kind of a bullish kind of announcement or a bearish announcement. But I think we get an announcement one way or the other, and that announcement should put a floor under gold, because if they do a new currency, I guarantee you it's going to have some type of gold backing. We don't know how much, but some type. And that's going to put a floor under gold, I think, at $1,800. I'm hoping. Maybe I'm talking my book and I'm praying here. But if gold holds 1,800, I think we get to, an all-time high, either this year or next year, and then we take off to the races.
Yeah, and I think that's a reasonable assessment of the Brics meeting as well, where I tend to get the feeling they're not going to come out and say we're launching the gold-backed currency. We've had a couple of Brics officials say that they're not doing that yet, although when you look at some of the things Russia has said publicly over the last year, indicating that there is a move in progress to de-dollarize in some form, and hopefully we'll get a little more clarity on that in the next week. So certainly does create quite a backdrop for gold based on that and all the other things that you mentioned here. And Don, of course, I couldn't let you go without touching on silver a little bit. And I know you've written and spoken about in some of your interviews that you expect gold really to be the main driver, and that it's silver that will be following along for the ride. And perhaps you could touch on how you see silver performing, obviously with the advantage silver being quite a small market. So when we do get significant inflows from a mainstream perspective, that's really when we could see a move that is along the lines of what many silver investors have been looking for. So anything you could share there would be great to hear.
Yeah, great. All right. So this will be the last one. But before I get to the gold and silver, I want to say a little bit more about the Brics currency.
Sure.
And the reason why I think it's going to happen. I don't think, first of all, I think China and Russia are kind of in an agreement that they want it. And I think they both want it for kind of similar reasons. Russia wants it because I don't think they want to trade in rubles, because I don't think countries really, I don't think it really is in their interest to kind of force rubles on people, like Europe, for instance. Europe doesn't want these rubles, and I think they want to kind of move away from doing international trade in rubles.
Right.
It makes a lot more. I think it works more for them to have this Brics currency to be able to trade in. And then it's the same thing for China. So China, I don't think China has actually stated that they do not want the yuan to be the international reserve currency. They don't want countries holding yuans on their balance sheet as a reserve, because they see the U.S. as basically being trapped by being the reserve currency. And we are, and that's a whole different discussion. But I think the U.S. is in a bad. It's not. It's actually it's somewhat good to have the reserve currency, but when it goes south, it's bad. So the U.S. is going to have a really hard time when we lose that currency, lose that reserve status. So China always thinks long term, and they're like, no, we don't want the yuan. So I don't think that China and Russia want to do international trade in their currency. And they don't want to do it in the dollar. And so that's why I think they will create a new currency within the next 12 months. Okay, so now let's talk about gold and silver. So I always call gold big brother and silver little sis. Sometimes I call gold the big dog. But I think, and the reason why I call it big brother and little sis is because I think I see a silver as being more feminine. We just don't understand silver. She's just wild, right? So she has to be feminine. So I call her little sis. But gold is, this massive market. It's about 13, 14 trillion of total value, and about 4 trillion just in the bars alone. So, silver is just, is a tiny market on a dollar basis, especially when we look at above ground inventory. Like, how much silver is there available to buy today versus how much gold is there available to buy today. It's unbelievable. The discrepancy is just stunning. I'll give you an example. So back when Sprott created their PSLV ETF, when they raised their money they got their money and they went to buy the silver, they couldn't find enough silver. They had to wait. It took them, I believe, at least 3 months extra, 3 to 6 months to finally fill the order. And the final silver that finally came in had the same year. It was the current year. In other words, it came out of the ground. They ordered it, but there was no inventory. They couldn't find any. This is, I don't know, 3 to 5 years ago. And it's gotten worse now. And so back then, when they started PSLV, there was not enough inventory, 1,000-ounce bar inventory at that time. And I think it was 90 million ounces, how much they tried to buy. There wasn't that much inventory above ground. And so 1,000-ounce bars, I think, is the real key here for silver. And so I really feel that once gold's going to leave, the big brother's going to leave, little sister's going to come chasing after him. So once gold gets above 2,100 and breaks out to an all-time high, that's when silver will come racing, outperform gold 2 to 1. But once gold goes to 2,100, silver gets to 30 very, very quickly. It'll come running. And then it'll outperform gold, of course, running from, today it's at 22 all the way to 30. So then from 30 to 50, silver will be, But what I said to you earlier is that silver this isn't about silver. This is all about gold, the debt bubble, and the bond market, and somewhat indirectly stocks. So the big money will only buy gold when they have to, as a hedge to protect themselves. And so they'll start buying gold, once it gets above 2,100, 2,200. And when they start buying it, then they create this wave of buying by the retail crowd for silver because they can't afford gold. People see that gold's going up, but they can't afford gold, so they buy silver. And that's when kind of your fear trade kicks in. So the fear trade starts in gold, and it starts in gold because this big money is afraid of their assets. So if they're going to protect their assets, they can't buy silver because silver isn't big enough. They got to buy gold. Gold's what, is a big, huge market where they can protect themselves with gold. You can buy $1 billion with gold. You can't really buy $1 billion worth of silver, not physical. And so gold starts this fear trade, and silver just comes along for the ride. It has nothing to do with silver. It's just coming along for the ride. And it's that retail money, that retail trade that comes in, and they start buying the physical. And there's not enough silver physical to go around for both your fabricators, who need about 70%. Once the investors want more than 30, you have to get above, they start soaking up that above ground inventory, and it starts, and before you know it, it's gone. It's that PSLV type of situation. The above ground inventory is gone. And once it's gone, all the 10-ounce and 100-ounce bars above ground, you won't be able to find them. Your local silver store, no way they're going to have any. And the big websites aren't going to have any. The only place you'll have a chance to get it is probably on eBay, and you have to pay a huge premium. And so that's what I think is going to happen. So you're going to get a shortage in silver. It was my call. Sometime between $35 and $50 silver, I'm expecting a shortage. The only thing that could really prevent that from happening, in my opinion, is that you get a global recession and there just isn't a lot of demand for fabrication. So let's say that the fabricators only need 60%. So we get it's basically a 1 billion ounce supply. And then, the fabricators only need 60%. So 400 million ounces is enough to cover, the retail crowd. I mean, that's a possibility, but I'm still expecting a shortage. And so that's it.
And even that possibility is somewhat offset by the degree to which a government doesn't go into recession, and with the green mandate, and I mean, some of the solar numbers and the projections that continue to come out of China certainly seems to make it hard to imagine that we'll really have a big glut there, but certainly something we'll be keeping an eye on. I know that you'll be keeping an eye on, and Don, can't thank you enough for everything you laid out there today. Quite well done, sir. And perhaps just before we wrap up, you could let folks know, obviously you have goldstockdata.com in the background there, but I'll pull up the site and maybe you could just tell people what you do over there.
Okay, so yeah, it's for people that want to invest in mining stocks. So the database has about 900 PM miners, and I analyze all the stocks. So you get basically a lot of data for PM miners. You get my analysis, plus you get, you know, their balance sheet, how many ounces they have in the ground, and their cost. It's basically a fantastic tool for anybody that invests in mining stocks. Highly recommended. If you own any mining stocks, definitely check it out.
Well, you certainly do a lot of great work with the mining stocks. Obviously, your columns on Seeking Alpha as well, and perhaps also one other thing I'd like to mention: how to invest in gold and silver, and touch on that for a moment.
Yeah, if you own any PM miners, you want to read my book. It's like a textbook, and I do, it's basically I show you how to value these miners, and when I say value, I'm not talking about so much about the doing any type of formulas, but all of the various data points, the complexity, understanding what to look for in a miner, if you will. It's yeah, you can see there that 125 ratings, people like it. It's a really good book. And then yeah, also follow me on Twitter if you want, Don Durrett at Twitter.
Well, we will have the links to all those in the description field below. And Don, great to catch up with you as always. And we'll have to do this again soon. And certainly will be an interesting second half of the year with a lot of these things coming to a head. And just appreciate you laying everything out here. And thanks again for making some time.
Thanks, Chris. I appreciate it. It was a good talk.